Happy Tuesday. Welcome to our live stream. Gosh, it kind of catches up on me. 3 o'clock Tuesday afternoon, busy day today, a lot going on. We're going to talk about the Federal Reserve probably meeting right now. I don't know what time they break for the day, but tomorrow we'll find out. I think what everybody's expecting, I've seen all of these polls out there, 96% that the Fed will drop interest rates 0.25%, a quarter of a percentage point. Not that big a deal, in my opinion. The Fed will meet two more times this year in November. I think it was October and December, I think it is. The expectations are they're going to drop the rates in those two meetings as well, December being the final meeting of 25. Federal Reserve meets 8 times a year. So we're going to discuss what I think is going to happen with rates coming down. I think it's already baked into mortgage rates. We've watched the 30-year fixed rate mortgage drop over the last week or so, somewhere down around 6.3%, depending on what channel you're on or what lender is putting out their rates on the internet. Not a big deal, right? I see a lot of these creators are saying rates are crashing, mortgage rates plummet, mortgage rates tank. I mean, they're not tanking. 6.33% is not a tanking mortgage rate. 4% would be a tanking mortgage rate. I think as we go through the information today and we talk about this, I want to caution everybody that houses, for the most part, are priced in that 2 and 3 handle. So that's how home prices got up to where they are right now. We have seen home prices really weaken, soften across the country. Seeing it here in Maryland a lot. We're going to go over that. I'm going to pull up my MLS. I'm going to show you I'm going to just randomly pull it up, go over a couple counties, and show you the actual amount of houses that are have experienced at least one price reduction, as well as the days on market is skyrocketing. We're seeing things that I haven't seen in years. Agents calling back. You make an appointment to see a listing, and you don't contact the listing agent. They're following up within hours or the next day saying, what did your client think? Are you going to write an offer? Submit something. It really is soft. The housing market is soft. And I have a lot of people that are reaching out. There are buyers that are wanting to get off of the shelf right now. So the question is going to be, and we have a poll out there as well, and you guys can vote on that poll. We'll keep checking it throughout the live stream. But the poll is if mortgage rates drop to 5.5%, which we are far away from that. We're a full percentage point away from seeing this for a 30-year fixed rate mortgage. Home buyers will start bidding wars again and still want cheaper houses. 81% so far. It's only 37 votes. This will increase. You can do us all a favor and vote. And I believe in this, wisdom of crowds kind of theory, where collectively, I mean, you guys are out there in the market. You're the smartest thing going. I can come out and give you my expert advice on what I think, but it's really the comments, the polls, the calls, the emails that really show me on average that a slight interest rate movement in a downward movement is not going to do anything earth-shattering with bidding wars starting again. Now, that doesn't mean that a property isn't priced really low and that it's in a highly desired area and multiple people, 3, bid on that house. But anyway, let's kind of talk about the Federal Reserve a little bit. So the FOMC, what that stands for, and that's the committee that's meeting right now, is the Federal Open Market Committee. And this committee consists of 12 members of the board. It's called the Board of Governors of the Federal Reserve System. And there's a map that you can Google search if you want and find out where these 12 districts are and what areas they make up. But this was established as back in the day as a good way of representing the country. I personally think it's off-sided. But anyway, they meet 8 times a year. And they will. It's October and December is when the next 2 meetings will be. And many economists, as I mentioned earlier, have said that they think that we're going to get a 0.25% rate cut and that they'll drop rates again in October and December. And after each of these meetings, it's like a day and a half meeting, somewhere around 2:00 p.m. Eastern time, the Fed chairman, who currently happens to be Jerome Powell, will do a press conference, and that's scheduled for 2:00 tomorrow. And he'll come out and say, their mandates and what their goals are and keeping employment and price stability and all of the standard things that he'll say. But I think everyone is expecting that he will say, based on what they're seeing with jobs, the jobs reports coming in pretty weak, is that, to try and stimulate the economy with a rate cut. Maybe that will be 1/4 point, like I said. So the current target rate right now, so the Fed rate, and a lot of people think that the Fed rate is something that mandates long-term rates, like a 30-year fixed rate mortgage, and it's not. Through the years, they do mirror each other a lot, but as we saw last year when the Fed cut rates 9 months ago, mortgage rates went up. Now we are seeing that ahead of this, if it is a rate cut tomorrow, we're seeing the market bake in, which is kind of giving the impression that the Fed will cut rates, that the mortgage market is baking in a lower rate or some type of downward movement, even though it's not directly correlated to this short-term rate that the Fed, the FOMC, regulates. Right now, the Fed range is in 4.25 to 4.5%, and the current overnight Fed trading rate is at 4.33%. Now, a lot of people say, well, what is that rate? What does that mean? I'm not a banker. I'm not even a financial expert, really. I'm a real estate broker, but I'm forced to sort of analyze a lot of the data and learn about these types of things because it is our financial market, and the housing market is a big part of the U.S. financial market because housing is such a big part of GDP. I mean, we're looking at, if you took all of the housing related costs, including the jobs that are created, the products that are purchased, every time somebody spends money to fix up a house or go to a big box store like Home Depot, that's all GDP. And, they say that housing accounts for about 30 to 35% of our GDP. So when the housing market is weak, this affects our overall economy. It also affects blue collar jobs. I'm having, one of my clients is having carpet installed tomorrow. It's almost like a next day job. Someone else I know is having ductwork cleaned. They called somebody. They're like, we can be there tomorrow at 8:00 in the morning. All of these things that I'm seeing and that I'm hearing, and I've been a contractor myself for 35 years, and I know a lot of people, all of the things that we see happening right now are showing a major softening in the market, the housing market, and everything related to that. And that includes the contractors. They're looking for work. They're cutting back. They're not hiring like they were. And when I say they were, 2 years ago, 3 years ago, when they were just looking for people, now they're kind of pulling it back. We've already seen where home inspectors have been affected by this and have had layoffs. Mortgage brokers have had layoffs. They're begging for these rate cuts because if mortgage rates go down, they don't even care about the house sales. They want refis because they make money on refis. So mortgage companies are a lot of them are struggling. They're cutting back. They're laying off. Title companies. I mean, everything housing related is weakening, and we're seeing that result really show up. In fact, one of my frequent guest that I have on the show, John Hoffman, just sent me something. I hadn't even really had time to look at it, but he specializes in foreclosures. And there was apparently news today where the report came out that there's a 35% increase, I think, in August foreclosures year over year, foreclosure filings. So we're even seeing these types of things show up. So I think the pressure on the Federal Reserve is, hey, we need to stimulate spending. And a lot of this stimulation of, just comes really from companies buying stuff and making investments in their business. So they're the ones that take out these rate variable loans so that they can buy inventory for their businesses or so that they can expand. So I think there's a lot of pressure on Powell right now to cut these rates and sort of stimulate the economy. The problem is a lot of the economists feel that if they cut rates too fast, too much too fast, that we'll start seeing inflation rise again because we're just over 3% in the CPI inflation numbers. And the Fed was saying, hey, we want these to be at 2%. So I think somewhere around that 3%, which a lot of economists say is not even bad. I remember early on, a few years ago, they were asking Powell, like, why this 2% mandate? Why 2% year over year? And they just felt like that was the number because a lot of economies and a lot of countries are completely satisfied with the 3% year over year. The problem is not the percentage of year over year inflation so much as it is what we experienced when we saw massive inflation, 7, 8, 9%, and a lot of products, 20, 30, 40% inflation. So when we're looking at year over year inflation numbers coming down, that's called disinflation. It's not called deflation. So it's not actually dropping. Prices aren't dropping. We're just seeing the year over year price slow down, increase, slow down. So anyway, so who borrows the money? What are we talking about when the Fed is saying, look, we're going to drop our Fed rate, that overnight rate? Banks borrow this money, and it's an overnight trading rate is what it's called. And it's where banks borrow from each other. And so their reserves are put into the Federal Reserve, and then the Fed regulates this trading rate, and this is where banks can borrow money from each other. Now, the Federal Reserve lends money as well, but the Federal Reserve first wants the banks. They want you to borrow the bank to borrow money from another bank before they go to the Federal Reserve. So anyway, what types of loans are affected by the Fed rate, right? Because it's not mortgage rates. When we hear people come out and say, we need Powell to drop the Fed rate so that we can have people buy houses again or have cheaper mortgages, first of all, we are so far away from where we were at 2.75% for a 30-year fixed rate mortgage. As prices were skyrocketing on houses, now they're already high. The rate has gone up, but the Fed rate really has nothing to do with the mortgage rate. It affects loans like credit cards, HELOCs, home equity lines of credit. These are variable rates. So you get a HELOC, you have somebody, let's say you have equity in your house and you need money. Some people took out home equity lines to go and buy a second property or an Airbnb. They had that kind of equity in their house, so they sucked the equity out. They put a home equity line of credit, which was really cheap, And then the prices skyrocketed. And then a lot of people were in deep trouble because their payment on their HELOC outweighed any profits that they were receiving on their Airbnb or whatever they used that money for. And they were having a hard time paying it back. But these are variable loans. So certain auto loans are variable interest rates. Personal loans can be a variable rate. Some private student loans can be a variable rate, meaning that if the Fed raises the rates, your payment goes up. If the Fed drops the rates, your payment goes down. Now, a lot of people have credit card debt. So you think about it and you go, okay, let's say I have a $10,000 credit card debt and I'm being charged 25% interest. And there's no cap on it, by the way. But I think a lot of people are in that 25% interest rate. I've seen as high as 30% on a revolving charge card, a credit card. But let's say that you are in debt to that bank for $10,000 and you're making the minimum payment at best. Maybe you're paying a little bit more, but every month you're watching that balance grow because you're being whacked at 25% annual percentage rate. Do you think if the Fed rate comes down and the credit card company could drop your interest rate 0.25%, number one, would that make any difference to you whatsoever? Or number two, will they even do it? Because they're not required to. Right? So usually when the credit card companies have you, and they have you when you can't pay off the balance at the end of the month or when it's due, before it starts accruing interest, once you go beyond that point and can't pay it off, they have you. They know they have you. Now, what might happen for very good borrowers, and I've already started seeing it, you may start getting offers where they say, look, transfer your balance. We're going to give you 0%. Or maybe these low rates will have them offer you maybe a 6% rate to transfer your credit card balance to a different credit card. So I think that if you do have debt and you're affected by interest rates, any drop is a step in the right direction. But I'm just concerned that it's not going to be enough, right? So let's talk about home prices with the mortgage rates. So I deal with I have a lot of conversations with home buyers, want-to-be home buyers. As you can imagine, we have a pretty big following on YouTube. I get people that reach out all the time, and they want to ask questions and talk about prices coming down, seeing houses sitting on the market for a lot longer, putting in offers, having problems with agents not wanting to write an offer for them. I have a video that's coming out in the next couple of days doing some reactions to some stories, and somebody was saying that their agent never even put their offer in. They know that their agent didn't present an offer, that it was too low or whatever, and ghosted them and stopped talking to them. I get a lot of comments that are coming in. If we look at 30-year fixed rate mortgages, home builders have been offering 3.99% to 5.5% fixed rate 30-year mortgages, and it has not moved the needle a bit. This has also been something that has been available to existing home sellers. They could buy down someone's rate. I think where we are, and I'm going to show you a chart here, but I think where we are in with me getting a lot of your information, because my advice or my expertise is limited to what's in my head, right? I mean, I can think about things and strategize the best made plan, but it's really the testing of the testing of the waters, the testing of the audience, the testing of the buyers. is really what gives me the indication as to what I think will happen if we have something like mortgage rates that drop to 5.5%. And that's why this poll, we can check that again. Let's pull that up. That's why I put 5.5%. There are a lot of people that want to say things like, oh, the magic number is 5.5%. Kevin O'Leary was one. I did a reaction video to Kevin saying that's the magic number, 5.5%. The golden handcuffs from the sellers come off. Everybody comes off the shelf. The buyers start going wild again. They'll be buying houses like crazy, 5.5%. I have in numerous videos gone over calculators showing you that doesn't change the payment much at all. The affordability, that doesn't really give you that much more of a home price to cut rates by a full percentage point because everything else is expensive. They're not going to drop. If home prices don't fall, they're not going to cut property tax prices. They're not going to cut replacement insurance, homeowners insurance. If your house were to burn down, what would it cost to replace the house? These insurance companies, as long as the prices are high, are pricing it like that. You get something, your rates go up every single year. And even on my investment properties, my commercial properties, I get something every single renewal period from my insurance company that says we have readjusted your replacement cost, and this is the new replacement cost, and this is your new rate. Your insurance is going up every single year. So we've already seen what happens when we have 5.5%. Mortgage rates did not go to 7 or 8% overnight. It was very fast. They started raising rates in March of 22. Yeah, they went up fast, but we saw people slowing down and buying houses before rates got anywhere near 7%. The ones that were buying the houses were people that have a lot of money. People that have cash. They're the only ones that have moved the needle of year over year price increases. Believe me when I tell you this. It's the median buyer, 59 years old in the last year. It's the 29-year-old 39-year-old first-time home buyer, right? Not 29, 39-year-old first-time buyer. First-time buyers dropped to decades low. They were a third or more of our homes that were being sold. So when we're watching all this stuff that we've been hearing, all this propaganda of year over year, home prices are going up, the median price is rising, the average price is rising. If you're not looking at the data and that's all you look at is headline information, you are uninformed. And unfortunately, the uninformed buyers are the ones that prolonged any type of adjustment because it was fueled by agents hearing the headline news, agents pricing it based on comps from months ago, 6 months ago. I had an agent today tell me, well, Todd, your offer on this house, 3 years ago, a comparable house sold for. I'm going, why are we having this conversation? Why are you taking me back to 2022? They're not comps. So there has been a whole lot of stuff that has happened and a lot of people that have been pushing the narrative that have been keeping these prices elevated for as long as they are, but it's finally catching up. I had somebody made a comment on my video, I don't know, a couple days ago. And they said, like, why would I buy your home buying course, Todd? You've been telling us for 5 years or whatever. I haven't been saying for 5 years. I started saying that the home prices were going to come down. It was going to turn. And I started saying that in 2022 in the spring. All right. There's been a lot of, I'm seeing it now. Okay. So it didn't happen in 6 months or a year or 2 years. We're seeing it. But we did see a huge change and shift from the moment that I started, reporting on this. We saw home inspections come back into play. That's a move in the right direction. So it's been a progression, right? Where we went from people going nuts, not having home inspections, overbidding $100,000 on a $400,000 house. In most cases, within a very short period of time, the average purchase raised the comp 12% in America. So, and that was done instantaneously. If someone, the average, I'm telling you, was over 10%. So agents were pricing it at the top of the comps, and then we were seeing the offers coming in at a minimum of 10% over list price. It was happening at such a rate, never happened like this in my career, where it was happening in such a rate that brokers were creating things called appraisal gap addendums, which basically meant if you wanted your contract accepted, because your offer had to be so ridiculous over comparable prices from just a month ago or just a couple months ago, that the appraiser was saying, there is no way I'm giving you that price on the appraisal for your loan. So people had to sign appraisal gap addendums that said that they would bring the rest in cash to the table. So I will overpay you what you want, overpay what the comps say in the neighborhood. Historical price overrun, right? I'm going to pay you way more. And people thought that that was good and that that was common and that was sustainable. I mean, where is that ever a good thing when you have that much exuberance that you overinflate and overheat a market so much, and then you're paying 3 times for the house because you have a 30-year fixed rate mortgage, and a lot of people aren't going to be able to sell. For years, they have to keep it, and you're so front-loaded in your interest payment. So you are really not buying down that mortgage. If you're not paying additional principal every month, your payment, if you bought 2 or 3 years ago, you almost owe exactly what you financed. Less you're overpaying of your appraisal gap contingency and any other down payment money that you put down. You may say, okay, well, I can sell it for less than for more than what I owe on my mortgage, but that doesn't mean that you get all your money back if you put 15 or 20% down on the house. Well, what I'm saying here is that we have to put sense to this. There have been so many people that have reached out to me that are in buyer remorse that want to sell their house. I'm looking at houses for sale in Maryland right here. It's happening all over the country, but in Maryland, I'm physically seeing where people are listing their houses that bought them in 2023. And they can't sell them. In 2023, we had way better mortgage rates. Right, 2022. I mean, so what does it take to erase in the mind of a buyer that has been sidelined or that's coming online when you can talk to your peers, a lot of them, and they say, I wish I wouldn't have bought a house, or I wish I would have waited. I'm talking about first-time buyers here, right? Which is the meat and potatoes of our housing market. Right, that is affordable housing. You don't call affordable housing $1.1 or $1.4 million that a repeat buyer, home buyer, has upsized, or maybe that's different what coast you're on. Maybe that needs to be a $2 million house. I took a trip down to Florida. That's why I wasn't here last week, and I did a sort of like a beach tour, and because I wanted to. You hear about this Florida housing market, and one of the things I wanted to do was analyze the real estate along the West Coast, the Gulf of America side of things. And I'm telling you, I was amazed at the prices, 15 million, 16 million, 20 million, 10 million, 12 million, 20 million, crazy. Where the hell these people get their money? No idea. And a lot of these houses look to be vacant, like closed up. Maybe it's off season there at this moment. But houses that were for sale had massive price drops, and they were still 1.6, 1.8, 2.4 million. They dropped $200,000, $300,000. Well, what level do they have to get to for somebody to buy this $2.4 million house that's not even on the water? Also, the amount of construction that I saw was mind-blowing. I mean, they are building on just about every corner. It's insane. The interesting thing was nobody was working. I remember going past this one it looked like a condo building that was being constructed, a small building, but there was a handful of people working on it. That's it. I mean, 6 months ago, a year ago, you would have seen crews just busting like crazy to try and get these places finished. Now, you can look at it and you say, is it the labor market that are they having a hard time getting help that can build these? Or are they in financial trouble? Are they waiting for the interest rate to come down so they can borrow more money or refinance their debt in the construction phase? I don't know. But it was really, really crazy to me. So I saw, it was like, if you didn't know what you were looking at, you would drive down the street and be like, damn, they're really building in this place. This is crazy. Beach after beach after beach town. And I'm going, man, where are the people? Where are the workers? This is during the week. Why isn't anybody working on this site? Why is this equipment sitting on the site and not moving? So it's very interesting. We'll see what happens. But look, I want to talk to you buyers for a minute. I'm not telling people not to buy a house, but you have to be thinking about this. If you have an agent or a loan officer that is pressuring you saying, hey, the rates are getting ready to come down, or they're crashing, they're coming down, rates are coming down, you better make your decision now, because people are going to start bidding wars and prices are going to go up. I don't think they are. Now, that's my opinion. That is my opinion. In 2007, I want to pull up a chart here. We'll pull up a couple charts. We'll look at some data. Everybody see my, there we go. All right. This is the federal funds effective rate, this overnight trading rate that they're talking about dropping. My chart is interactive. Can they see what I'm hovering over? Yeah, okay. There we go. All right. So September, we saw the Fed cut rates. Okay. And there hasn't been a rate cut since September of 24. So we're hovering right at that 4.33% that I mentioned earlier. But I want to pull up another chart, not yet, but I want to talk about the Fed. So there is a way that the Federal Reserve can drop mortgage rates, and they can do it by buying mortgage-backed securities. So that's called quantitative easing, a type of quantitative easing where they can buy mortgage-backed securities, and they can buy them at a lower rate, or kind of set a lower rate for that than an investor might do for locking into long-term lending. So you think, well, do I want to invest if I can make more money? And by the way, if the Fed starts cutting rates, if you have cash in a bank and CDs and stuff like that, all that stuff goes down too. The only reason you're making so much money at 5%, 4.5% on your CD or your money market account with your cash, because, I mean, remember what used to be, if you're my age or older, you remember making 7%, 6-7% on your cash sitting in the bank. I mean, you look forward to getting your bank statement. We didn't have the internet where you could just go on and see how much money you have in your account. You basically had to wait for your statement to come, or go in the bank and say, could you give me a balance on my account? Or just be really good at compounding interest and figuring out how much you had. But your cash, if it's sitting in the bank and rates start to drop, that rate's coming down too. They're not going to offer you the money. They don't need it. If they can get it from another bank, they don't need it from you, because they're lending out the money that you're putting in and depositing. They're 10Xing that and lending it. But anyway, look at this chart. I mean, something is just something interesting to see, right? This was the Fed rate going all the way back to 1954. But look what happened in the 1980s when we had those double-digit mortgages. So a lot of times the mortgage rate does mirror the Fed rate. But look what happened here. I mean, this is going back 2000. They started dropping rates. We had a recession. And then in about 2004, this was our big run-up of the housing market right before the GFC. But really from like 1997 to 2005, 2006, the housing market took off. And that was pretty much in the height of when I was doing the most building and remodeling and things like that as a contractor. And I mean, everything you touch turned to gold as far as real estate investing. And we had that big bubble. And in 2007, the Fed panicked because we went into the GFC, and the Fed panicked and started dropping rates and dropped them almost to 0%. You can see that here. And it really has stayed that way. I never really imagined that the housing market, when it crashed, would be almost a decade long. But it took for some people to sell their house, especially on a higher end home. If they bought it in 2006, it was probably 2022 before they could actually sell it for what they bought it for. And they had to work on the house all along the way because that was a long period of time to do absolutely nothing with your house. But look at this, almost 0%, the Fed dropped the rates. And then the Fed started doing some tightening here by raising interest rates, and nowhere near to where they are now, but going up into 2019. And then in 2019, we started to see rate cuts because we were actually going into a recession. Right before the pandemic, things were getting kind of bad. And then by the time we got to the pandemic, the Fed reacted, and boom, here you go, almost at 0% again until they started to raise there in March of 22, like I just said. So anyway, that's the history of the Fed rate. You can see, but I do want to pick up this other chart that I had created. And I've had this on my show before, but I just wanted to bring it back up again because I wanted to show the magnitude of how far we've gotten away from median incomes, household incomes in our country compared to home prices. Now, these are new home sale prices, median sale prices. And I'll just explain the lines here. The top line, or this dark blue line, is the median sales price of new homes. The orange line is if we would have stayed on the trajectory of real estate prices rising to keep up with inflation 3 to 5% year over year. And if we would have kept that up, and this dates back to 1960s, that orange line would be where our home prices should be at 4% year over year increases. And a lot of people say, well, house prices go up 3 to 5% a year. That's normal. Well, no, that's not the way it's worked. We've seen certain periods of time where home prices skyrocketed, like right before the GFC 08 crash, and then to right now. The bottom line and the difference between the blue and the green is because the Federal Reserve didn't pick up median household income in the U.S. until where you see this green line in 1984. So prior to that, I had to go through the internet sources and kind of piece it together. But oddly enough, it almost matches perfectly. But what I'll point out before we get into some of the ways that the Fed has manipulated or allowed home prices to skyrocket by suppressing mortgage rates, by buying mortgage-backed securities, is I want to take us back before the gold standard. And I'm not a gold bug, so I have these people on my channel. I can tell you one thing, Peter Schiff, I mean, he's been on my channel many times. I've been to his house in Puerto Rico and Connecticut, interviewing him. Very fortunate enough to have what I consider a very good contact in somebody that makes a lot of sense. I mean, gold has skyrocketed. I wish I had it. But prior to Nixon taking us off the gold standard here in 1971, or finally putting the stake in it, because I think it was happening over time, but he officially took us off August 15th, 1971, you can see that the home price inflation pretty much stayed in line with median household income. Miraculously, after they took away the gold standard is when we started to see home prices, median new home prices, go higher than median household income. And if you just focus on that green line and the top blue line, you can see we've really never been farther away from what you can buy a new home for versus what the average household income is, median household income is in the United States. There's no wonder why the numbers aren't working anymore and why people are enslaved to their home, their mortgage, their repairs, and things like that. Now let's look at some of these things that took place throughout history. The Federal Reserve didn't buy mortgage-backed securities prior to the GFC. 2009, they started responding to the housing crash by saying, look, we need to drop the mortgage rate because no one's buying houses, they're only losing them. And because the price of the home was dropping so rapidly where your neighbor could buy your neighbor's house for $100,000 less than you owed on your mortgage, and it's the same exact house, well, why not just let my house go? So there were a lot of people that were just flat out bailing out of their houses and could quite afford their mortgage payment. It wasn't just subprime mortgage. In fact, I get really aggravated when I hear people talk about it. Yeah, there were liar loans, there were bad mortgages, people could get mortgages that shouldn't have had them, but that was not the only problem. The problem is back then home prices skyrocketed and people had to get a liar loan to buy one. Makes sense. But let's just exasperate the problem by making you giving you the ability to buy a house with only 3 or 3.5% down. And let's let you have bad credit, lower credit scores. Let's let you have a bankruptcy not too long ago and let you buy a house again. Let's just keep the thing moving. I don't see much difference in many ways from where we were back then, other than we were way worse because housing affordability, the HAI, the Housing Affordability Index, even through 2006, the height of the market, the median household income could find a median home priced home that was affordable for them. Wasn't the case in 2022. We dropped below that threshold for the first time in maybe history, but certainly arguably since the late 70s, early 80s, when interest rates went to double digits. But let's remember, a lot of people was only one household income back then. So we didn't have people working 2 and 3 jobs with a side hustle, driving Uber, Uber Eats, whatever. I mean, it's people just trying to do everything they can to make enough money to pay their bills. But let's look what happened. So this home price line, so we're going to move along here. 2003, we started seeing home prices really jump. I want you to pay attention to something. 3 times in history since World War II, that we've seen median new home prices drop. Only 3 times. It balanced out. If we look at that top line and we look at, right here from 1989 to, I don't know, can they see my cursor on there? I can't. Yep. 1989. You see that little bit of flattening here from 89 to 91. But then home prices continued to rise until we got to the peak of 2006. And then we saw home prices drop. If you were buying a house back then, you really got a good deal. I was buying houses to renovate for $50,000, single-family houses. You're not seeing that in great areas. They needed complete renovation, but the Fed put a stop on it and said, we got to stop this price decline because we have no reverse gear here in the U.S. We have no room for deflation, especially when they're leveraged. And we're seeing banks collapsing because the houses aren't worth the mortgage, what the bank has outlaid or investors have outlaid. So they stopped it by saying, look, we got to buy these mortgage-backed securities because nobody wants to buy a mortgage. And that's when we started seeing mortgages drop south of 4%. So here we go. It worked. All right. Home prices started to rise again. We got up to 2019. We started to see home prices drop because we were headed into a recession back then, pre-pandemic. I don't know if you can remember back that far. But for the next session of buying mortgage-backed securities, Fed responded, 2020. That combined with massive stimulus packages, a lot of bailouts, halting student loans, mortgage remodifications, cutting up to 30% of the mortgage balance, dumping it on a balloon loan, second mortgage on the back end of your mortgage and moving you from a 30-year to a 40-year mortgage. In doing remodifications. They did everything they could to save it. What was the end result of that? The end result was we had home prices skyrocket, which is what you can see here from really 2020 to 2021, 2022. So, in my opinion, a couple things are going to happen. Either, number one, we're going to see home prices continue to decline with rate declines, with mortgage rate declines. I don't think we're going back to 4% mortgages again anytime soon, if ever. I think we may see mid-5s. I don't think it'd be enough. I think prices are going to either continue to drop or that they're going to flatten out and we'll go through a period of stagflation for maybe 5 or 7 or 10 years. We bought early, we pre-bought our home appreciation in a very short order, in a very short time period. It's my opinion only, what I'm saying, but I don't see, if you were to analyze what would need to change for home prices to skyrocket again with dropping mortgage rates even to 5.5%, we would have to see massive economic growth in the U.S. And I hope we do. I hope that happens. I hope that the president can do that. And then we can either pay our employees more money, or it'll be opportunity for people to start their own businesses and make more money. And then that will make paying these prices justifiable. But I don't have a high confidence in that happening anytime in the short term. I think the pain that the Fed had said originally years ago when we were going through the pandemic and when he was talking about raising interest rates and actually doing it, I think it's now we're at that crossroad where we're seeing job reporting that shows weakening in the job market, and we're starting to see where people are pulling in their spending. And so I think it's too little too late to start doing these rate cuts right now. I think the damage, in my opinion, a lot of the damage is already done. It's just going to take time. We're just going to have to work through it. Now, what does that mean for somebody selling a house? If you want to sell your house, you have to decide whether you want to do it now while inventory is still relatively low, or do you want to wait until inventory increases, because that's the next progression. If rates drop, inventory should start to hit the market. More inventory to choose from with a weakened buyer demand. There are a lot of people that say we have a pent-up buyer demand. I think a lot of our buyer demand has just fizzled out. I think we saw a lot of the action. We saw it in advance with people saying, I got to buy now because if I don't, I'm not going to have any houses left for me to buy. And the younger people that are coming on, they're saying, man, I don't need to take that debt on right now. That's what I'm hearing. That's what I'm getting. You guys can comment. Otherwise, I would love to know what you have to say about it. I'm just going. My expertise stops at what's in my head. I'm not a predictor. I don't have a crystal ball. I have a feeling, and my feeling is wrapped around what I hear, what I see, what I'm experiencing, what other people are telling me. And when I put all that data together with a little history, and I say, well, we have seen this type of story before, I have to come with a realistic conclusion that what I'm saying, I believe, is right. You can disagree with me, and I'll admit it if I'm wrong. We have seen the housing market in the majority of the country soften significantly. Days on market has increased. The question is, will all of that absorb just like that? And I don't think it will. The housing market doesn't work that way. The housing market is slow moving, like you have seen, unless you have 2.75% mortgage rates, which I don't think we'll have. So I think that this is going to be inconsequential to the mortgage industry. Let's talk about when you should refinance, because a lot of people are going to bite onto this. And a lot of mortgage brokers, and I mean, they need to eat and pay their own mortgage payment. So they're going to be all for you refinancing. And one of the common things that you're going to hear is, well, do you have credit card debt that we can consolidate? Well, keep in mind, refinancing costs money. Your amortization schedule is going to reset. You may have lenders that tell you that it won't with them. What that means is all of you finally got to the point where $50 a month or $500 a month is going to your principal. Whatever it is, you should know how much of my monthly payment actually buys down my mortgage. When you refinance, that's going back to day one again, or $5 is going towards your mortgage payment, right? So you're back to paying a lot more in interest. And you have to do some type of financial calculation to say, well, how long am I going to stay in this house? Because if you're a remorseful buyer and you're like, man, I can't wait till I can sell, and you may only be there another 4 or 5 years, it may not be worth it financially for you to refinance. Now they're going to say, but you can consolidate. There's 24% rate more, interest rate credit cards. Well, you should be smart enough to read through this. You need to pay those credit card rates or balances down ASAP. Cut the credit cards up for the time being. They'll send you new ones. Don't cancel them, because that hurts your credit from what I understand. Don't call them up and say, I'm canceling this card. Just cut them up. You can call them up and say, I lost my card or I shredded my card or whatever. I need a new one. But start paying those balances down. To roll that debt, that $10,000 or $12,000 into a 30-year fixed rate mortgage is insanity. Get them paid off. Sell things that you don't need to pay those credit cards off. Don't let that be the reason why you refinance. You should be refinancing if you have a major rate cut. You bought it 8% or 7.7%. It's now at 6%, right? You're well over a point. Now start looking at that if you're planning on staying at the house. you don't want to get into this game if we're seeing a downward trajectory where now I want to refinance again. The loan officers love it when you do that. Refinance 3 times. Refinance it a quarter of a point or a half a point. Refinance it a full point. Refinance it. Yeah, I'll take your money every time you want to refinance. You have to think about it. Be smart. Don't just jump into action. Crunch the numbers. Find out what the costs are going to be to refinance. How much is it to refinance? You're going to have to get your house reappraised. So if you only put 3% down, that may affect whether you can even refinance if there's been a softening in your market depending on what you paid. You could be underwater on your mortgage. Some of those vintage years, Lance Lambert has a great chart on that. He frequents us. That's what he does. He's a data analyst for the housing market. But he's saying this, a lot of this 22 and 23 and 24 vintage mortgage vintage is underwater, especially if you're in the Sun Belt. So you need to know that if you're going to refinance, you're going to get it, pay for another appraisal. And if you waste that $500 or $600 or $700, however much it is, on an appraisal, and they come back and say, well, you need $50,000 to refinance, you got to think that through in the beginning and say, do I even have that? Before we share my screen, I want to log into my MLS. Because I want to show you guys a couple snapshots. It's interesting. We have expanded. I have Bright MLS. We've expanded our lending, our reach. Bright has partnered in exchanging data. So I'm not going to go into it today, but I can see into Florida, and I no longer need my friend Phil Simonetta to do that for me. You guys would be trying to get my keystrokes and saying, I know his password to the whoa. You'd be able to log into my MLS. All right. Let's see what we got here. Okay. Let's go ahead and show the screen. Let's take a look here. So let's just go into, and I'm just doing this. This is as live as it gets. Man, I don't want to knock my water over again. I don't know if any people remember that. Riley, you do. I don't think I've seen anybody come with a roll of paper towels faster than I didn't even I missed my keyboard totally, completely. Anyway, let's look for some houses. I'm going to change this to, you can't really buy, well, we'll change it from 200,000 to $1 million. And we'll just go through and pick a couple counties. Go into Baltimore County. And we're going to just do active because nothing else matters for this search. And hopefully you guys can see my screen. And I'm just going to sort this. Now, the reason I picked 200,000, I mean, you can't buy much in Baltimore County for less than $200,000 that you can live in. It just doesn't exist. So I just did 200,000 to $1 million. And these green arrows here are price reductions, just so you know. And beside it are, and I can move it closer, these are days on the market, just for you to check out here. I'll just scroll through. There's 25 per page, all right? And what we're looking is for down arrows. Now, we got one here that has an up arrow, and This is probably, I don't know why they would have raised the price. They went from 150 to 219,000. Who knows why? I don't know. But that doesn't really work in most markets. Most of the time we see new home builders doing that. They'll raise the price. They're notorious for trying to keep the prices going up. But look at these down arrows. And I just want to show you their large percentages. 118 days, 132 days. They're dropping it 20 days, 74 days. If you're buying a house, if I were a first-time buyer and I was buying a house and I was on a budget and I'm trying to spend, get a nice place, but I don't want to go crazy, I'm going to make a list of my must-haves. I'm not going to want to finance more than 3 times my household income. So if there's 2 of you buying it and you make $100,000 gross a year, my rule of thumb is don't finance in a mortgage more than $300,000, 3 times that. Live within your means. Find something that checks your boxes, but don't get carried away if you want to get into homeownership. I would also look for houses that have been on the market for more than a couple of weeks. It's the most exuberant time in the first couple of days, first 3 days, first 5 days. The best chance for the seller to make the most amount of money. If I'm working for the seller, that's what I'm focusing on, doing everything I can for that launch. How are we ready? Making sure that, because they're your waiting buyers. They're the ones that are ready to pounce on it. And if they don't pounce on it, you got problems, because now you're crickets. No one's coming and you're dropping the price, which we're seeing 101 days. So I'm just going to go through. Look at this. In this price range, 264 to 270. I mean, almost every arrow is going down. I mean, these are big percentages. Look at this. 282 to 295. Out of 25, 1, 2, 3, 4, 5, 6 of them haven't had price drops, and probably should, because this one's 93 days on the market. What? Now, this is ahead of everyone's talking about price, mortgage rates dropping. Oh, mortgage rates are going to drop. Do you think these sellers would be dropping their prices if they believe that mortgage rates are going to drop? They would be pulling them off the market and saying, you know what? We'll wait. 12 days price drop. Now, it could be $1. I mean, it would take me forever to analyze and go through each one of these things, and I don't think you care. The bottom line is they're not selling in 2 days or 2 hours. And this is a massive, let's just go back into our criteria, because a lot of people are like, yeah, but you didn't show Anne Arundel County. Let's show Anne Arundel County. I could do this all day long. Here you go. This is a different county. I took out Baltimore County completely. More green arrows going down. Look at the days on the market. Why? They can't see it? Did that just happen? All right, here we go. Now we're up to 1 million. Okay. But anyway, let's take some comments. Let's look at what I want to do here is, and by the way, they're major markets. Baltimore County, Anne Arundel County. I could go into PG County, Howard County, Frederick County, Carroll County. You're seeing the same thing. All right. And so no agent saying no, that's not true. I just showed you the back end. This is not, which is what you should be asking your agent to do. You should be saying, let me see what you're seeing. Show me these trends. Don't give me some report that's a month and a half old, right? Because really right now, today's the 16th, we're really going to start looking at from this point on, we're halfway through September, and we're only able to see in a lot of these market reports August at best. So you want to see current snapshots, what's happening over the last couple of weeks. That's really what you should be paying attention to. All right, before we move on, let's look at that poll because I'm just kind of curious. All right, 445 votes, 78% still wants cheaper houses, and that's what I believe. I believe that the buyers, at least the comments that I'm getting, the information, which, by the way, is thousands of comments, thousands. All you have to do is look at one of our videos, read the comments. They're not for me. And Dan in the Dirt, by the way, had said something. He's got a different account here because he thinks we banned him or something. Dan, we didn't ban you, man. I have no idea. In fact, we wouldn't ban you. You've been great. You've been a great supporter. If you're still listening right now, I don't know what happened. Why your Dan in the Dirt username isn't working. Let's pull. Here we go. Foreclosure.com. Let's show this real quick. Foreclosures rise. This is what I was telling you earlier about John Hoffman. Sent me something before I came on the show. Foreclosures rise amid affordability struggles. 5 key takeaways. I don't know. We don't want to watch that. Here you go. Foreclosure activity in the U.S. has been increasing for 6 consecutive months with a 1% increase from July, but an 18% rise from the previous August. Affordability challenges are prominent, with home prices showing a 36.1% increase in typical list prices since August of 2019, pushing some homeowners into financial distress because they overpaid. Nevada, South Carolina, Florida have the highest foreclosure rates in the country, with 1 in every 3,987 housing units. You may say that that's not a lot, but if you figure driving around a neighborhood and saying, okay, we drop a pin here, somebody's in financial distress. Foreclosure filings. Things don't start to happen until you're 3 months behind. Texas, Florida, look, is even worse. Texas, Florida, California. Well, not worse than Florida or South Carolina or Nevada, but look, worse in the country. It's crazy. All right. We got any comments we want to address? All right, let's go ahead. Here we go. Austin, thank you so much. Appreciate the super chat. There will be 5 sellers for every 1 buyer that comes back in the market, with rates coming down into the 5.5% range. Expect downward price action and continuing home prices. Appreciate your hard work. Thanks, Austin. I think that this is I think it's accurate. I think we haven't even seen, look, short-term rentals getting crushed in a lot of cities. They've been talking for years that neighborhoods don't like them. HOAs have been trying to ban them. HOAs can get together and ban them easier than municipalities. Dallas was going to ban them. Then they reversed it because they said, well, it's unconstitutional. You can't take landowner rights away, but you can do it if your long-term tenant doesn't pay your rent. They can prevent you from kicking them out. They don't give you a break on your property taxes while you're not making money as an investor. But sure enough, the tenant has all the rights. Sorry for that. Just went through this. But I do think that the market just overheated. The exuberance, it wasn't real estate agents' fault, all of their fault, if there's any to blame to put on them. And I'm not saying that there wasn't multiple reasons why the exuberance happened. I'm sure some agents played into that. But it was the buyers that decided to move forward. a seller selling a house, they deferred maintenance for 10 or 15 years, and a buyer just bought it anyway with things not working. You can complain about it later, but at some point you have to say, it was my fault. Just like putting a bad tenant. Did I do everything I could have to not make a placement mistake? I mean, sometimes you want to say, that's okay. The credit's not what we wanted it to be, but we'll do it or whatever. Then it goes bad. The person doesn't pay you because their credit was bad and you had standards, but you went off of them. You're a buyer and you said, I'm not going to buy a problem house, but you did it anyway. No matter what it is, you have to then look and say, look, this was on me. I did this. What else? I'm glad to see the survey showing people have sense and have woken up. We have a very intelligent group here. It's not, I mean, I think I have one of the best audiences that in my genre that you could possibly have. I think my audience is very educated. And you can tell by the comments. They're good comments. I mean, yeah, you get some that are kind of out in left field, but for the most part, these are people expressing what they're going to do or not do. I can't see it. How many votes is it? 471. There we go. Sorry. 79% still want cheaper houses. All right, where'd my comment go? Glad to see the survey showing, okay, could care less about the rates. Prices are ridiculous, and I think this is what we're going to see. Look, you have to look at that. The same thing as a credit card. What do you want to do when you buy something? Don't you want to pay it off and own it? Don't you want to actually have equity? Wouldn't you rather buy down your principal on your house and actually have equity there, a savings there, than to give it all to the bank? Of course. People by nature, we finance things, but it's not the most ideal thing. If we could write a check for it, wouldn't you rather do that? Now, if you're in the business of making money on real estate, you say, no, I want to use cheap finance and use that bank's money. Like the banks get it from each other at a cheaper rate so they can mark it up if you're in that kind of business. But if you're owning a home or you want to own a home, you want equity, and you don't want to make the banks rich, you want to make yourself rich. If you have a savings account and you're paying 7% and your savings account's giving you 3% or 4%, if that, maybe nothing at all, and you can buy down the principal of your house, but does it make sense when you're buying down principal on something that was way overpriced in the first place? No. It doesn't give you a good feeling about it. You're like, yeah, I got to bought this house for 50 grand less or $100,000 less. It's the same thing going into a store. Do you price shop when you go into the store? Your credit card may be giving you a free interest for 90 days or some kind of an offer, or 30 days of free interest if you pay it off. And when your balance is due, when your statement's due, then when you go out to buy something, you don't say, well, I've got a cheaper rate here. I can pay more for this product at the store. No, you're a smart consumer. You're pricing it out. You're saying, well, this store has it for this price. Amazon has it for this price. I can get it for this price. You don't say, well, what's my credit card say? No, because I'm planning on paying it off because I don't want to make the bank rich. I want to be rich. So I'm going to buy it. I want to be price conscious. So nobody likes overpaying. The only time you do is when you think if you're going to miss out if you don't buy it and it's going to go higher, which does happen from time to time, as we've just witnessed. But was it worth the price of giving up everything else? And now you have a money pit. Probably not. which is why a lot of people are selling their houses from 22 and 23 already, 2 and 3 years into it. With labor costs and building material prices increasing, will older existing houses stay high? You know, Charlton, I mean, what people don't, they argue with me about this all the time. A house is a depreciating asset. So they fall apart. Don't fix it and see what happens. Your appliance breaks, you don't fix it. You get potholes in your driveway because it gets cold and hot. You don't fix it. Your fascia and soffit starts to rot or fall off in windstorms and you don't fix it. Your flooring goes bad and you don't fix it. Your roof goes bad, you don't fix it. It starts deteriorating and falling down around you. So you have to spend money on a house, regardless if it's an older house or not. But the question is, will the price keep up? It depends on the obsolescence. Is there functional obsolescence in the house because they haven't done anything in 25 or 30 years? So older house, but does it make it worth more money? No, it makes it worth less money because for somebody to come in, the building costs are high, so it works against that existing home because they have to do a lot of that work that the seller didn't do to keep it up. So no, not really. If you maintain that existing house, it probably will be nicer than any new house. I'll give you an example. Let's say you bought a 1960s or 70s style house and it's had a brand new kitchen put in recently, last couple of years, maybe even 5 years ago. It's quite possible that homeowner spent $50,000 or $60,000 on the kitchen renovation because they were doing it for themselves. So they picked quality cabinets, quality appliances, quality backsplash. Well, that new home probably spent $7,000 or maybe $13,000 or $15,000 on the kitchen with appliances. So you can't say that older house is worth $50,000 more because it has a new kitchen, but there is an attractive element to that renovation or that upgrade where somebody will give you more for that house than maybe the neighboring house because of the upgrades, the quality of the upgrades. But older existing homes need to be redone. I'm going to go look at a house tomorrow, a couple houses tomorrow that are very distressed. I'm hoping one of the things I want to do, I'm trying to buy something where I can do quality renovations and walk you through the entire process. This is what I want to do. I want to start focusing on, and if you haven't noticed in our channel, we've been a lot less, talking about all the problems in the world and more focused on real estate because that really is what I want to do in life is educate you, home buyers and sellers alike, and homeowners on the real estate, keeping you updated in the real estate industry, but also giving you ideas and ways of doing things and saving money and things. So this kind of next chapter that we want to go into is really more about me starting off with a house that I can walk you through the entire process. The buying process, the looking at it, what I'm thinking, what I'm seeing, which I do, by the way, a lot. I give a lot of information in my home buying course. And, but I want to take you through, like, why did I buy this house versus something else? And what were the decisions that I made? And what do I want to do? What are the core things that I want to do to this house that, one, you can do, right? Not tear it down, which I'm very good at. But what can I show you that you can do so that when you're out looking at a house that you could say, look, I can do that. So when you're looking at some of this, what I believe will be inventory that will come on the market, that will be distressed, where you can get your best deal, your best opportunity, whether you're using renovation loans, whether it's a FHA renovation loan or conventional loan. But I want to start diving in and showing home buyers, look, how can you take advantage of this distressed older home where you can go in and do things that are feasible to make that house a better place and build equity, because that's how you make money in real estate, when you own it and you do things for less that of good quality that increase it. And I'm going to walk people through the permitting, any engineering phase if it needs it, permitting process, the whole thing. So I'm excited about that. But we have changed a lot of our content on our channel. I think that affected the algorithms. The views have really been hit. If you want to help us, one of the ways that you could help us is to share our channel and to comment and to like and to subscribe if you haven't already done so, and it just shows up. But if you could help us, because our views are down. And I want to think that it's because we've switched, not that you don't like me anymore. I want to think that, I hope that, or at least that you would tell me if you didn't like me anymore, but I'm hoping that it's just the algorithm is readjusting more of our content because we're more focused on education now. I have a video, HOAs, I'm surprised. I don't even think it's at 10,000 views. I mean, it's crazy. And it is like that's a badass video, man. If you're buying a house and you're looking at an HOA and you don't watch that video, well, I mean, you wouldn't know about it, but it's a really good video. Walk you through the history of HOAs and things that you should be careful about and watch out for. I mean, this is real life stuff, right? The biggest purchase you ever make, and there it is, 6,000 views. But you know what? It's not the quantity, it's the quality. And as long as we're reaching people and helping people, I'm happy about it. There you go. It's a cool video, documentary style. I mean, Joe, man, he freaking went overboard on this thing. I felt like I was watching like a movie. I don't know, Riley, you probably had a lot to do with it too. I'm not trying to say one versus the other, but we got a badass team here at Sachs Realty. Anyway, that's the Fed dropping the rate. John Hoffman was in the house, man. This is the guy I was talking about that sent me the email. And frequencer, he's a guest. It's a friend. Fed dropping the rate is a Titanic losing a deck chair. Nothing. Watch the mortgage rate start heading up, which is the flip side of that. I didn't even get to that point. I wanted to get to it, but I don't know that we're there yet. I think we're going to see what's happening is right now, all the lenders out there are trying to, if they say, look, if we can get refis, because people aren't buying houses, but if we can get a lot of refis, then that's the direction that we want to go in. And a lot of the lenders are coming out, dropping the rates right now because they're getting ahead of it. They're like, oh, the Fed's going to drop rates. We think that's the trajectory for mortgage rates. We're going to offer downward pricing. Hopefully we'll snag some people along the way until they see what inflation numbers, if that reverses, if we see job unemployment go up and all those other things, which a lot of economists believe will happen, then we'll see mortgage rates go the other way. Unless the Fed steps in and starts buying mortgage-backed securities. How can I reach you? I am an appraiser, and many, many changes are happening in my industry that will impact agents and buyers and sellers. It'd be great to be on with you. I'm easy to get a hold of. Send me an email. Some people are like, yeah, right. I mean, we try to keep up with it. It can be overwhelming, but send me an email. That's the best way. 30-year-old married to 36-year-old, but we want, but we will not buy one of these overpriced homes. Our money does us better good in stocks. This is a lot of the comments that I'm getting. When I put out there, do you think interest rates are more important? Do you think home prices are more important? Well, the common answer is both. We want them both. We want better prices and we want better mortgage rates. Well, you may not be able to get them both. You got to settle. Maybe 5.5% mortgage rate is what the new norm will be for a period of time. But 7.7% is a 50-year running average. We're not at bad mortgage rates right now. I would have loved to have a 3%, a 6.3% mortgage when I bought my first house. Thank you, Jeffrey. Appreciate your support, constant support. Thank you so much. Sachs Realty, when you see the mega building projects, hasn't money for most of those already been borrowed and allocated? Yes, and a lot of it has gone up because commercial lending is this adjustable rate. So a lot of your commercial loans, if I'm going to go out and I'm going to build a house on speculation and I'm going to get an interest-only loan, if I'm going to keep the house or if it's my personal primary residence, I'm going to get an interest-only loan, and then I'm going to put it into a permanent loan or permanent mortgage once all the draws and inspections have been done, and then it's going to roll over into a permanent mortgage. But I'm going to get these interest-only stipends along the way if it's 7 steps to build a house or whatever, 7 draws to build the house. So they finished the basement and the foundation. I get a draw. I pay the contractors. They finish the framing and they dry it in and where they put the roof and the shingles and the windows and the doors, and I get a draw. And then in some of these draws are more or less than others, and I pay my bills. And all the while I'm paying interest only on that. And that's sort of the same thing as if I'm getting a loan for a bank to do it on speculation, a spec build. I'm getting a interest only, and that's fluctuating. And depending on your loan type, it's not uncommon to have a loan that if the rates go up, your payments go up. Your interest only loan, short-term finance. Well, it's the same thing when I had that guy on the show that did the retirement communities. What was his name? That's terrible, isn't it? Anyway, he was saying we have a retirement housing, assisted living shortage in the country. Something crazy. I mean, there's a staggering video. The guy's brilliant. Pete, you didn't like him very much. My audience didn't like him very much. They thought, I mean, he's rich, but he was brilliant. I mean, if you listen to people, I mean, Elon Musk is brilliant and rich, and I mean all these other, but for some reason people didn't like him. Boomer created crisis. I don't know if this is that's the long one. Yeah. Anyway, he was saying that, look, we need to drop interest rates. And I was like, dude, what are you talking about? These are not bad rates. You can get a 7% commercial loan. I would love that all day long, all through my career. 7% commercial loan. He's like, yeah, no, we can't make any money on building these. Maybe that's why the people didn't like him. But the bottom line is he was an investor waiting to build big projects until the financing came down. Well, commercial loans are very short-term loans. Maybe they're amortized. Your payment is amortized over 20 or 25 years, but it's a 5-year term. So you get your money in 5 years, it balloons, and you got to pay it off or refinance. Now, a lot of people, me included, had commercial financing at 3.7%, 4%, 4.25% on a fixed asset, commercial asset. Went through the 5 years. I had some 10-year, it ballooned, and I was looking at interest rates that were double. Go from 4% to 7.5%, that's double. Your less tenant build out, structure, your vacancy rates are going up, your costs have gone up, your profits have gone down. And you're sitting there going, I can't pay this extra interest payment now to refinance it. So what do? You got to hope that you can pay it off, or that you can do something else creatively, or that you have a lot of money you can put down on it to refinance a smaller amount so the payment doesn't kill you. Either way, yes, you're buying, you're front loading, you're getting these loans, but you're taking draw payments as the projects going through. So let's just say I'm building a condominium complex, and it's all spec, or apartment complex. Let's go apartment complex, because condos is not accurate, because it can be, because if your sales slow down. But let's say I'm building an apartment building, which a lot of investors have been doing all over the country, especially in college towns. You want these kids to live in luxury. and certainly way better than the dorms. And that's what they do. They 4 or 5 of them. They got theaters and all this stuff. So you build this inventory. Well, as you're completing projects, let's say you have a major draw that's coming up, but you're not signing leases, or you're that condo building and you're not doing sales. You say, do I want to take that next draw? Well, your contractors want to be paid, but you start seeing this bottleneck where they're like trying to juggle the sales versus the money and paying their contractors, and they get slow paying their contractors. The sales are slow. The leases aren't happening. The condo sales aren't happening. We better slow down the money, the build out. We better slow that down because we can't afford to pay the ones that we have. And now the project starts stalling because the next phases aren't being funded. So yes, they may get the approval or the loan commitment to fund the project to the end, but there's a lot of things that can happen, including bankruptcy in between. So when you're looking at these projects that I was talking about, driving the Florida coast, seeing and going, wow, these big projects, and there isn't a whole lot of activity going on. One guy working, 5 guys working on a big site, multi-acre site, machinery not working. I'm not talking about lunchtime. Dwayne Clark. Thank you. That was his name, Dwayne Clark. You can check him out. Saddest part of the quality of some homes is terrible. So folks overpaid for shoddy product, cardboard sheathing, poor workmanship, have seen some pretty nasty stuff as builders wanted to get out. Guys, look. Oh, man. This is, yeah. Products are junk. Faucets, electronics, they break. Things do not last like they used to. And the fancier it seems that it is on the outside, the worse it is in the inside. I mean, we're seeing things in houses that are not that old. Faucets cracking and leaking around their, the handles. Turn the handle on, it's got a crack, a leak comes up through not that, the material is junk. I can't wait to see what this $1 million new construction looks like in 20 years. I can't wait. It's going to be very interesting. The drywall, paint products. Nothing's the same. Adhesives. We have to take all the good stuff out of them because they're toxic. And, all your subflooring is glued down with junk glue. It'll only be a couple years of expanding and contracting and people not climatizing their house at a perfect level, and it gets too hot and it gets too cold and the floor starts moving, and then now you've got squeaks everywhere. Yep. What else we got? There we go. According to the Census Bureau, average home prices have already dropped 14.31% since December of 22, the peak of 22. It's exactly what I said to people, that the housing market was going to crash. It's going to come down. It wasn't going to stay like this. It has happened in many different forms. You haven't seen the foreclosures for multiple reasons. I don't think rate cuts will save this much needed price correction. I am going to show you shortly the Midwest. This is in our live streams. I'm going to pull up. I haven't even looked at the data yet. Riley pulled it all up. I don't even know what the data is going to tell us, but we'll experience it together. Usually I do. I look at it ahead of time, but we'll both be surprised of whether prices are going up or down in the Midwest. All right, so let's do that. That's one more time on our poll. I want to see if it still stayed around that 78%. 582 votes, 79%. Mortgage rates dropped to 5.5%. Home buyers will still want cheaper houses. All right, let's take a look and see what is going on. We will start out in North Dakota. We're going to do this kind of quick. North Dakota is going up. We're not getting into the specific cities. These are average home prices year over year. Zillow reporting. Zillow aggregates data from all over the United States. If you don't like them, I'm sorry, but they collect more data probably than any other site out there. And so I do like to look at not their specific zestimates, but when they're looking at aggregating all the sales data, which we'll get into now, it does tell a story. So I don't really think that this is a big thing to look at, this 3.8 year-over-year average North Dakota home value. I think that can be skewed, but what I like to look at is, some of this other data. 48.5% of sales sold under list price as of July 31st. And again, we're looking at backward-looking data when we look at these reports, and a lot of that is because, we have to wait till it closes. You buy a house today, it doesn't settle for 45 days, 30 days. So we don't really know what those numbers are. So we're constantly looking back as to what did they pay for the house when they bought it July 1st. Well, we don't know until July closes out. And then we see 48.5%, 27.9% over, 20 days, median days to pending, which is honestly pretty good. I mean, I think that's, and we start to see here that in North Dakota, we are still seeing an upward trajectory in recent year over year in what they said. But I don't think it's that big of a deal. I still think that prices are softening. South Dakota, and look at these median or these average prices too. I mean, a lot has to do with that. I mean, if I could buy a house in Maryland, a nice one for $315,000, I'd be jumping for joy. Now you're looking at stuff that needs tens of thousands of dollars worth of work for $315,000, or you're looking at a condo or a townhouse or a row house. South Dakota, 64.6% were sold under sales price. We start looking at what's happened since June. We saw a dip from June to July, and then we are seeing a slight pickup from July through the end of August in the median list price. Wisconsin, again, year over year is increasing. Let's take a look at their 1 year view. We're still seeing some steady rise there, 36.8%. So a lot less of the houses in Wisconsin. This is macro. You're going to find markets where we're looking at the macro level. And part of the reason why I do this is to show you can dive into a city and bring up the Coeur d'Alene or whatever it is. And I don't know if you can you cast that onto this thing? It's just going back to North Dakota. Let's see what Riley pulls up here. You can go into what are you doing? Coeur d'Alene or whatever. I don't even know how you say that. Coeur d'Alene or Delaware. That since we're in Idaho. I just know that because one of our Coeur d'Alene or however you say it, yeah. And Nevada. In Nevada, I was corrected. I said Nevada. Somebody said nope, it's Nevada. All right, here we go. Cordial, whatever. Let's scroll down. I'll never get that right. And I'm not moving there, so it doesn't matter. All right, so look at that 1 year view. Jeez. Craziness. Something was happening there. And I think they saw our podcast with him, and he said that everybody was racing to Coeur d'Alene. All right, thanks. So you can go into specific cities and see what's happening here. Minnesota housing market, looks like it's on the rise. 1 year view, same thing. Still seeing price increases, low 36.8%. Under list price, Michigan, 257. I mean, who has an average Michigan home price of 257? That's crazy. I feel like we should be running to Michigan and buying houses. Same thing, 1 year we're seeing some increase, 42.3% sales sold under list price. That's something to look for. That number's climbing up. Nebraska, 272,499 average Nebraska home value. Still seeing an increase in value there. 47.3% of sales under list price. So sellers are still trying to push the envelope, and the buyers are saying, no, we're not going to give you what you want. Iowa housing market. Yeah, starting to see these 57% sold under list price. Still very 22 median days depending. Missouri. Man, what a big difference, huh? We're starting to see that. You think Zillow is reporting it right? 45%. It's kind of hard to believe, but how does 45% of the people buy under list price, but they're showing year-over-year price increases? Kansas housing market. Come on, what's happening in Kansas? Look at this. 239, it was 237. So you're seeing an increase from June, a couple $1,000, 41% sales sold under list price. Right there. Midwest is big. Ohio. I know a lot of investors that are buying up stuff in Ohio right now. What's their 1 year? Headed up 43.8% with 9 days depending in Ohio on a macro scale here. Indiana. Man, I'll tell you what, something doesn't look right. 15 median days and 49.7% under list price. And then finally, Illinois. Here we go. Let's see what's going on in Illinois. All right. Well, Zillow's saying that prices are going up. 39.8% of sales under list price. You know, it was interesting. Last week we had a Phil Simonetta, wasn't that a week ago? And we were looking on Zillow, and they didn't match the price decreases that had happened on the MLS. In two of the listings that we pulled up, we only pulled up like 4 or 5 listings, but in 2 of them, they didn't accurately report that. So that's something we're going to have to look into for our next market report. Anyway, guys, we really appreciate you following us today and tuning in. Thank you so much for that. If you got something out of the video, you can hit that thumbs up and let us know that you did. We also have, if it's not greedy for me to ask, you can support our channel for $3 a month. You can join, and we're getting members joining. We appreciate that. It helps us to keep things going. $3 a month, you can join, get special emojis that you can use, and you get a little something different next to your name or your handle, and you get some other perks. You get 20% discount on our store, SachsRealty.shop, where fall's coming. You get these this cool shirt, this cool gear that everybody seems to love that buys them. We have water bottles and keychains and stuff like that. So we'll plug our store there, SachsRealty.shop. And if you know somebody looking to buy a house, you can always point them to our SachsRealty.education. We're working on a home seller course that takes a long time to put it together, that we're hoping that by spring, certainly we'll have a home seller course that will be on our SachsRealty.education. And feedback has been great on this. Thank you so much for those that have become students. And the feedback is you're learning a lot. And it only takes 1 or 2 things that pick up $300 the cost of the course. You're going to pick up 100 things. I mean, you're going to learn so much. It's almost 9 hours of content. And I'm walking you through the entire process from beginning to end, how to decide whether you want an agent, how to negotiate commissions, how to identify areas in a house that that would suit your needs. There's downloads, worksheets to print out. resource guides, sample contracts. There's so much that's in this thing. One of the common things I hear people say is, why would I buy your course? I can get it all on AI. No, I'm sorry, but you can't. You can get a collection of data, but you don't get me. And I'm the one that's instructing this course. And if you follow my YouTube channel, you know that I am very transparent and I dive in. You should check it out. If you know somebody looking to buy a house, you can gift this to them. If your kid or your grandkid is looking to buy a house, you can gift it to them right on the site. All right, guys. Well, we thank you again, and we'll see you next time.
Sachs Realty, Maryland broker number 607720, office number 443-318-4514, equal